Good morning, everybody. My name is Alex Held, and I'm with Arlington Economic Development. And we are thrilled to bring this Mason Law Clinic at BizLaunch back and get this going. This was a vision of one of the professors at George Mason, and to provide in-depth legal assistance for small businesses and startups. And we got disrupted by COVID like everybody else in the world, but we're back in a virtual format. And so we're just very thankful for the partnership that George Mason has provided. I look at when I think about a successful communities, one thing that they all have in common is a robust university system. So we're thankful for George Mason for donating their time and participating in this presentation. So we have our three speakers on the call here who will go in depth on legal entities. So we'll get that started here momentarily. But I wanted to make sure that you all folks are aware, but we in BizLaunch, we help small businesses and startups get going and thrive in our community. If there's any resources, we host periodic events. We provide one-on-one technical assistance, marketing plans, business plan templates. If there's anything that we can be a resource, we're here for you and we don't go away. And you might be interested in our upcoming program called Relaunch, which is an opportunity for small businesses to receive one-on-one technical assistance, in-depth technical assistance, help with marketing plans, financial planning, et cetera, as well as technology assistance. So we're going to be underwriting a website and e-commerce solution on behalf of businesses within Arlington County. So for more information about that program, just visit relaunch.business. And without further ado, I'll turn it over to Ken to kick off today's program. Ken.
Well, thank you, Alex, and welcome to everybody online. We're really enthusiastic about meeting all of you this way and having the opportunity to share a little tax knowledge with you. I am joined this morning by my colleagues, Mitch Gibson and Rebecka Haynes, who are both third-year law students at the Scalia School, the George Mason University Law School in Arlington. And here is the agenda of what we plan to cover this morning. We're going to talk mostly about the different ways to use different types of entities for your emerging business or your small business, and then what it looks like when you succeed and look for an exit strategy, what the tax consequences look like when you try to sell that small business to somebody else. Mitch Gibson is going to start us out, and then we'll switch to Rebecka Haynes when we switch to the corporation subject. We probably will have time at the end for as many questions as you want. We'll stay a little late if necessary, so feel free to send us questions on the chat function, and we'll try to take them all at the end of the presentation. And with that, I'm going to turn it over to Mitch, and Mitch, just signal me when you're ready to change the slides.
Will do. Good morning. As Professor Silverberg said, I'm Mitch Gibson, and I'll be talking about non-corporate pass-through entities. So next slide, and you can actually go 2 slides, Professor Silverberg. So if we're going to start with the simplest non-corporate business entity, which is a sole proprietorship. And the way that you can think about this is if a child decided to do a lemonade stand. They're the only one running the business, and all of the money is going directly to them, and they aren't registered with any state authority. The next kind of business entity is a partnership. So say the child's best friend decides to join them per business, and they start operating together and splitting the money they make. That would be a partnership. And it can have as many people as the two, or as many people who want to participate as possible. And it also doesn't need to be registered with the State Corporation Commission. Next slide, please. So the next structure that I'll be talking about is a limited liability company, or an LLC. And this is a registered entity. It's statutorily authorized, and it limits the liability for its members and managers. And the members are people who own a stake in the company. So this would be similar to shareholders in a corporation. Managers are either members or outside individuals who take care of or manage the business dealings of the business. And so an LLC can be either member managed, so everybody who is invested in the business takes part in making business decisions, or it can be manager managed. And so a member managed LLC, the investors are active investors. Manager managed, most of them investors are going to be passive investors. Next slide, please. So if you decide you want to be a sole proprietorship or a partnership, how do you form that and start doing business? And you just do that. You just start. So since you don't need any authorization from the state, you can begin doing business today if you wanted to. It is important to remember that some businesses require licenses, permits, registering the business name, or zoning clearance before you can begin. If you don't comply with these, there can be a fine, sometimes a very hefty one. For example, if you don't register the name that you're doing business under. So for a lemonade stand, let's say they decided to go with Arlington Lemonade and aren't operating underneath the names of the two children who own lemonade stand. The county could come in, or state could come in and give them a fine for not registering that name. And that fine can be up to $200 or $2,500 or a year in prison. So you really want to make sure that you take care of that if you're not going to be operating underneath your own name. And if our two kids decide they want to hire a third to help take care of the lemonade stand, but that person isn't going to be a partner, they need to make sure they have an EIN, or employer identification number, for tax purposes. And you get that from the IRS. Next slide, please. So there are some particular issues with partnerships that I want to go over. So having a partnership agreement in place before you start business is always a good idea. So a partnership agreement can cover a lot of things. It can be talk about how decisions will be made, if there's an even number of partners and each gets and they all get equal say, and say it comes out to a tie, how is that tie going to be broken? Which partners can bind the partnership for what issues? How gains and losses will be divided. So all these things can be included in partnership agreement. They don't have to, but having that formal agreement in place protects both the partners if something were to go sour in the future. And it can also help the partners clearly understand what their role is going to be in the business and what they can depend on each other to do. And this can be a great way of saving future relationships. So if you include how gains and losses will be divided within the partnership agreement, courts will generally respect those terms so long as they're not done for solely for tax purposes. And if you decide not to include that in your agreement, the default is that gains and losses will be divided equally between the partners. Next slide, please. So to form an LLC, you need to complete Form LLC-1011 and file it with the State Corporation Commission. But there are some professions like doctors, architects, or lawyers who should complete Form LLC 1103, and that allows them to become a professional limited liability company. There's not really a difference other than what profession is being formed. And the LLC should also get an EIN from the IRS. Next slide, please. Okay, so at the start, I said that these are non-corporate pass-through entities. So what is pass-through taxation? Next slide. Pass-through taxation means that the business itself is not taxed on the income that it receives. Instead, all gains and losses are taxed at the owner level. So with our lemonade stand, the two owners will be taxed for all the proceeds that they earn over the year. And pass-through taxation can be used for all of the entities that I've described, as well as S corporations, which Rebecka will talk about. The only type of business entity that can't use pass-through taxation are C Corps. Next slide. Okay, and so I want to go over a few of the advantages and disadvantages of using pass-through taxation compared to C Corps. And the biggest advantage that most people know about is a single level of taxation. If you're a C corporation, the corporation is taxed, and then as that money is distributed to the shareholders, it is taxed again. That doesn't happen with pass-through taxation, since it goes directly, or it's seen as the money going directly to the owners of the business. There's one level of taxation. You can also get pass-through losses. So that means if the partnership loses money through the year for whatever reasons, the partners can use that loss to diminish their tax burden from other areas of income. So say they earn a salary from their partnership, and then the partnership as a whole has losses, they can decrease the amount of that salary that will be taxed. But there are some caveats with the pass-through losses. There's limits that can be attributed to members of LLCs. And then there's also the qualified business deduction. As the name implies, only qualified businesses can receive the deduction, so it's important to determine whether your business would qualify before attempting to take that deduction. And because it's a little more complex, we don't want to go into all of the specifics of that, but we encourage you to look into that before filing your taxes with your new business. Some of the disadvantages of pass-through taxation, first is liquidity or phantom income. So this occurs when your business has made a profit for the year, but that money is kept inside the business and isn't distributed to the partners, members, or sole proprietor. When this happens, the owners are still going to be taxed on that income, even though they haven't received any of it. So your tax burden doesn't accurately reflect your personal economic situation. Tax consequences can also dissuade certain types of investors. So if you're looking to have like a venture capitalist come in, they're going to be a lot less likely to want to have some of the tax consequences that come with pass-through taxation. Pass-through losses are nice, but they don't want to necessarily be paying taxes for the income that the business is receiving, particularly if it's not being distributed. So depending on what your goals are for your business and how you plan on raising money for the venture, pass-through taxation can be a disadvantage. You can also only deduct $10,000 of state or local taxes per member or partner. So this would happen if the member or partnership does an itemized deduction rather than taking the standard deduction. So you could have a greater tax burden than the $10,000 per member or partner, but there is that cap set. And so that can be a disadvantage as well. And there's also the potential for a self-employment tax. And we'll talk about that a little bit later with some of the other employment tax issues that can occur. That's all I have. So we'll go ahead to go to Rebecka.
Hello, my name is Rebecka. I will be discussing corporations. So next slide. So to start off with, can corporations have pass-through taxation? Next slide. Yes, so corporations can elect to be taxed as an S corporation and be treated as a pass-through entity for tax purposes. Slide. And then again. So what is an S-Corp? You don't incorporate as an S-Corp, rather you incorporate as a corporation. An S-Corp isn't an actual entity type. You just elect to be taxed under subchapter S of the tax code. That's why it's called S-Corporation. And an S-Corporation is like pass-through entities that Mitch discussed earlier. The incomes and losses pass through to shareholders for federal tax purposes. And so you will pay on your individual tax returns and your individual tax rate, the portion of the income and losses from the company. Slide. So how to form an S corporation? First, you would incorporate in the state of your choice, simply as a corporation. And you should ensure the corporation meets the requirements to become an S Corp. There are some restrictive requirements that I will discuss on the next slide. And you should submit Form 2553, election by a small business corporation, by the applicable deadline. The deadline depends on whether or not you have a prior tax year or not. So if you're a C corporation with a prior tax year and you want to elect to become an S Corp, beginning with the next tax year, you should file by March 15th. The deadline's usually in mid-March, depending on the exact date, depends on whether or not you have a prior tax year. And the form must be signed by all the shareholders. Slide. So the requirements to become and remain an S Corp are that you must be a domestic corporation. You can only have certain shareholders. They have to be individuals, certain trusts or estates, meaning that partnerships, corporations, non-resident aliens cannot be shareholders. You cannot have more than 100 shareholders, and you can only have one class of stock outstanding. You can also not be an ineligible corporation listed there. And if the company violates any of these requirements, the company will cease to have S-Corp status and will automatically be converted to a C-Corp. Next slide. So comparing the S-Corp to other pass-through entities. So first, how is an S-Corp similar to pass-through entities? Like other pass-through entities, there's a single level of tax. As discussed, the company's gains and losses pass through and are taxed once at the shareholder level. There's also the benefit of pass-through losses, which can be beneficial as the losses may offset like other income on the shareholder's tax return, and they're limited to shareholder basis at-risk rules, passive activity loss rules. And there's also the qualified business deduction that Mitch mentioned earlier that applies to pass-through entities, including S-Corps. And so the way an S-Corp is different from other pass-through entities is it allows for tax-free reorganizations. Unlike LLCs, corporations can engage in reorganizations with other entities in a way that eliminates all corporate and shareholder level taxes that stem from the reorganization. And there's also the ability to provide stock options. So the provision of stock options for an S-Corp is far less complex than in an LLC. And S corporations can adopt both traditional stock options and incentive stock options. And options are valuable for a company because it gives them the ability to compete for and procure talent with stock options. But it's important to note that because an S corp can only have one class of stock outstanding, it's important to make sure the exercise price is not too far below the fair market value of the option on the grant date. Otherwise, the stock option may be classified as a second class of stock, automatically nullifying S-Corp status. And then that brings us to the easy conversion to a C-Corp. So if there comes a time when you want to switch to C-Corp status, you can easily convert to a C-Corp. Say you obtain VC financing or financing from foreign shareholders, the S-Corp will automatically convert to a C-Corp because the requirements I mentioned earlier have been violated. On the other hand, with an LLC, any conversion to the corporate form in order to take your company public must be made well in advance and with more work. Next slide. So C corporations. So a C corporation is just a regular corporation. Corporations are by default taxed under subchapter C of the Internal Revenue Code. Why it's called a C corporation. And so they're a separate entity distinct from its owners, and it's taxed separately. And the only way to form a corporation is through compliance with the state incorporation statute. And so a corporation can be closely held, which means it has only a small number of shareholders, or it can be publicly held, having a large number of shareholders and shares sold on the public market. And then some states have separate provisions for the organization of closely held corporations, which enable owners to dispense with some of the corporate formalities that are inherent in managing a corporation. Next slide. So what most people think of when they think about corporations and taxes is double taxation. So a corporation is subject to federal income tax separately from its owners. And so the corporation's tax is a flat 21% tax rate at the entity level. And then the profits accumulated after the corporation pays that tax is subject to further federal tax on the profits that are distributed to the shareholders as dividends. And so the tax rate for that would be 20%, would be a matched 20% tax rate on distributed dividends taxed to the shareholder. And so if the corporation distributes earnings to shareholders, those earnings are taxed twice, once at the corporate level and again as individual earnings, making the effective tax rate on those distributions to be 41%. And so now there's an exception to for qualified business stock held for more than 5 years after issuance is eligible for a 100% exclusion from gain on disposition, not to exceed $10 million or 10 times the taxpayer's basis for any one shareholder. So what is qualified business stock? Qualified business stock is issued by C corporation at its original issuance. The C corporation must be engaged in an active business, and the gross assets of the corporation do not exceed $50 million. So this exclusion often makes C corporations attractive for businesses likely to reinvest its operating proceeds. Next slide. So as a comparison between the C Corp and the S Corp, just to review. So the C Corp has double taxation, as I discussed earlier. And there's also the retention of operating capital. Equity holders and LLCs and S Corps usually insist on distributions of cash so as to pay taxes on their portions of the company's taxable income. Mitch spoke a little bit about this when he spoke about phantom income. And C corporations are generally able to offset their earlier tax losses because for a period of time, allowing the company to shelter its cash during its development and thus conserve more operating capital. So if you're a business and you anticipate needing early and continued expansion of your business, you may wish to form a C corporation for this reason. And also C corporation can issue more than one class of stock. There's exclusion for gain from certain small business stock that I spoke about. And there's unlimited deduction of state and local taxes. And then an S Corp has single level tax, like all other pass-through entities. They have pass-through losses, qualified business deduction, and there are strict requirements, limits on the provision of stock options and the availability of VC funding. So, yeah. And also the deduction for state and local taxes is limited to $10,000 per shareholder.
These are the employment taxes I promised you we'd talk about. So the first one, the employment tax, an employer is required to file a W-2. I'm sure most of you, if not all of you, have received a W-2 before. And as you know, that shows the wages, tips, and other compensation that an employee was paid. And as a part of the employment taxes, the employer is required to withhold federal income tax, Social Security, and Medicare taxes from the employee's wages. And then the employer also pays the federal unemployment tax. So this doesn't come out of wages and is separate from federal income tax, Social Security tax, and Medicare tax. If you are in a partnership or a sole proprietorship, you don't have an employer really, you are your own employer. So you don't have, same with LLCs, since you're taxed on entity level, you're required to pay your own Social Security and Medicare taxes. And so that you must pay those on your individual tax return if you're an employee of the business. And this is in addition to the tax for the members' individual share of the company income. Just to give you some numbers with this too, the first $142,800 of your net wages, tips, and net earnings are subject to the Social Security tax, but all of your earnings are subject to the Medicare tax. The Social Security tax rate is 12.4%, and the Medicare tax rate is 2.9%. You use Schedule SE to determine how much of the self-employment tax is owed, and half of that self-employment tax that you pay can be deducted when determining your adjusted gross income for income taxes. So it is half of it is deductible essentially. And then finally, for the employment tax considerations, S corporations need to pay a reasonable compensation to shareholder employees before they can do non-wage distributions to that shareholder employee. So you can't be working for the company for free essentially. You have to be receiving compensation as well as the distribution. And that's all we have for employment tax considerations.
Okay, thank you both, Rebecka and Mitch. There's a lot of pros and cons, as you can tell. Maybe you're sitting there wondering, why would I ever want to be a C corporation and incur that double taxation of 41%? That's not a very desirable outcome. Well, when you start a business, you have to decide what your objective is. And I'm going to discuss how the taxes apply to somebody whose objective is to start a business, to build it up, make it run profitably, and then sell it. And for an example, I'm going to use Mitch's landscaping service. And we've been joking with Mitch, telling him if this law business doesn't work out for him, he's always going to be able to go into the landscaping business. And it could even be more profitable. We don't know. So here's sort of a snapshot of the history of Mitch's landscaping business. This is not one guy with a lawnmower. This is a big business. As you can see, he's had hundreds of thousands of dollars of revenue every year. And this is what makes a business attractive to a potential purchaser, particularly in the case of a service business that does not have a lot of inventory and fixed assets. What they're really buying when they buy a service business is the revenue stream or the customer list. So the purchase price is usually going to be calculated with reference to the collections. Here's the offer that Mitch has gotten from this big landscaping company. And this is often how these offers are calculated and communicated to you. The purchaser in this case is going to offer to buy Mitch's business for 3 times the average annual collections of the business over the last 5 years. So if you add up the last 5 years of collections, divide by 5 and multiply by 3, you see they're willing to offer to pay $674,400 to buy out his business. Most of the time, when an entrepreneur sells their business, they're going to either have to continue to work for the business or promise not to compete with it. And in this case, Mitch is going to go back to the practice of law with his $675,000 in his pocket. So the purchaser wants to make sure that he doesn't pocket the money and then go back to his former customers and try to compete with them. So they will get a promise, contractual, that says Mitch agrees not to compete by soliciting any business from any of his former customers or from anyone else in the same zip code for the next 3 years. And in exchange for promising to refrain from competition, he's going to receive an additional $50,000 per year. So when you put those two pieces together, he's getting paid almost $825,000 for the business and the non-compete. Not a bad deal. Now we're going to take a look at how the tax laws apply to this kind of an offer. And when you see the different types of taxation, that will go into your analysis of the pros and cons of whether to have a pass-through or an S-Corp or a C-Corp. You can't really comfortably assess the value of this purchase offer on this basis. You have to look at what will go into your bank account after tax. So that's the analysis that we're going to do. First of all, you may be asking the question, why would somebody pay this kind of money for landscaping business? Let's see what the balance sheet of the business looks like. On the left is the balance sheet of Mitch's assets. You see he's got a bank account of cash. He's got some customer accounts receivable. He's got some partially depreciated landscaping equipment. And he's got current vendor payables, and he's got some payroll taxes he collected from his employees that have to be paid over to the government. So the net assets, the assets minus liabilities, is only $460,000. Why would somebody be willing to pay $675 for $460? Well, that excess is the intangible assets that go along in a service business like this. Those intangible assets are his customer list, his intellectual property. Perhaps he's got signs and logos, and there's value to the trade name, Mitch's landscaping business. He could have a very good website. He could have his own top-level domain name at mitches.com. And if you can't particularly identify the value of some intangible asset, then it's thrown into a category called goodwill, which is a sort of residual category of excess purchase price. And why am I even asking this question? Well, it figures into the way the transaction is going to be taxed. Now we're back looking at the balance sheet on the left-hand side. What we're doing on the right-hand side of this slide is what the buyer and seller have to agree on, not just the purchase price, but they have to agree on how that purchase price is allocated to different assets. The reason for this is that it makes a tax difference, and the IRS wants you to be consistent on both the purchaser and the seller's side of the transaction so that they don't get whipsawed, that both of you would put the best tax result on your tax return. So here, the purchase price is being allocated pretty much dollar for dollar to the identified assets on the balance sheet. It doesn't have to be, as long as the two parties agree. But in this case, cash is worth dollar for dollar. The receivables are all good, collectible. And you see that I've put the whole $214,400 of excess purchase price into the allocation in the goodwill line. I'm going to keep this next section simple and assume zero basis. For those of you who understand gains and losses, this is going to be a simplified example. Here are the different tax rates that could apply to different kinds of business. Remember that individual tax rate that you pay every year on the profits of a pass-through business could go as high as 37% under current law. But if you have it as a C corporation, current taxation is only 21%. But as Rebecka pointed out, if you have a C corporation, you pay the 21% currently, and then when you pull the profits out as a dividend, you pay another 20%. We also need to be aware of trying to get the 20% capital gain rate, which is a bargain for as much as possible of the sales proceeds. And then there's a little extra icing on the cake called the investment income, the net investment income excise tax that applies just on dividends and capital gains. So this is not simple stuff. Let's take the first example, assuming that Mitch set the business up for pass-through taxation. This was either a proprietorship, a single member LLC, or an S-Corp. On the left-hand side is that purchase price allocation that we just figured out. And when you sell a business that's in one of these types of entities, the IRS treats it as a sale of each individual asset to the purchaser. So here the purchaser, as you can see, is paying $214,000 for that collection of intangible assets. And that part is going to be taxed at the capital gain rates, the 20% tax rate, rather than the ordinary income rate, which for numbers this large could get up to 37% under current law. Here's how the taxes are calculated on the right-hand side. Mitch's total is divided up between capital and ordinary. Again, for the purpose of simplicity, I'm assuming 0 tax basis. The capital gain is taxed at 20%. The ordinary income is taxed at 37%. Do the math, and after tax, Mitch puts $555,820 into his bank account. Not bad. Could it be better? We'll see. This is just a graphic representation of what I've been talking about. You see Mitch with his single member LLC, and what he actually sells as far as the legal documents that are drafted is the membership interest in that single member LLC, but LLCs are disregarded entities for tax purposes, so it's treated as a sale of all the assets of the business. S corporations have the same result, but they may actually look like this on the legal documents. It looks like in this case, the S corporation itself is the party to the transaction, and it's selling its assets to the buyer. The buyer pays his cash to the S Corp, and the cash goes into the pocket of the shareholders.
Hunter? Yes.
Okay. Okay, but what happens if it's a C corporation instead of an S corporation? Well, again, 2 things are happening. Mitch is getting some of the proceeds for the sale of his stock, and he's getting other payments for the non-compete promise. And when a C corporation sells its assets and makes a distribution to its stockholders, it's going to incur that double taxation, the 21% plus the 20%. So Mitch doesn't like that result. He would rather sell his stock. And that's what we're going to try to negotiate for if we're representing Mitch in the sale. And if we're representing the buyer has its own tax reasons why it would rather buy the assets. It's a more advanced subject, but the buyer will get a stepped up basis for future depreciation if they can buy assets instead of stock. And then there's going to be the separate tax on the non-compete payments. So let's do this calculation. Here's what the tax looks like. If he can sell the stock, the entire proceeds of the sale of the stock are capital gain, taxed at 20%. The only part of this transaction that's taxed at ordinary income rates is the $50,000 a year that is paid for the non-compete covenant. Do the math. After tax, $634,000. That's a lot better than the $555 that we saw in the previous example. So why wouldn't everybody want to be in a C corporation when they're starting their business? Well, the answer is that double taxation that you experience when you are in the operating years. Can we do even better? Yes. Assume for a minute that Mitch is able to jump through all those hoops and get qualified small business stock, what the tax people will call Section 1202 qualified small business stock. If you qualify, you actually have zero tax on the sale of that stock. So even if your tax basis is zero and the full proceeds are $675,000, you have zero tax. You only will pay tax on the ordinary income component, which is the payment for the non-compete promise. And look at the difference. Here's the comparison of the numbers. First example, if it's a pass-through entity, either a sole proprietorship, a single member LLC, or an S corporation, Mitch's after tax was $555,000. If it were to be a C corporation and he's able to sell the stock, he would get capital gains rates and he would pocket $634,000. And the jackpot is when you can qualify for this small business stock exemption and have zero tax on the sale. And there you get $768,000 net cash. So vastly different outcomes for the exit strategy, depending on the form of business entity that you sell. When you start your business, you not only want to think about how you pay taxes during the years you're operating the business, you want to think ahead to the future and say, if I'm lucky enough to turn this business profitable, what's my exit strategy going to be? When you do have the sale of a business, there's a built-in economic tension. The buyer will always want to buy assets and the seller will always want to sell stock. And that's because of their different tax consequences. That's why the IRS requires the buyer and the seller to agree on that purchase price allocation, and they both have to sign off on it. And if they don't report it consistently in their tax returns for the year of the transaction, they'll hear from an IRS agent. If you're dealing with a transaction like the sale of a business, you have to assume that your buyer is sophisticated and they understand these tax consequences. The buyer knows that it's worth more to him to get a step up in basis for future depreciation. And another one of the important reasons why a buyer wants to buy assets rather than stock is if they buy the stock, they're going to inherit everything that's on the balance sheet of that business, including all the liabilities. If you remember, we had vendor payables and withheld payroll taxes of $50,000, but the buyer is always going to ask the question of, what is there that you didn't show me on the balance sheet? What unknown liabilities, or even worse, known but unrecorded liabilities could there be? So even though these tax consequences are all subject to, arithmetic and you can figure them out, there's these non-tax advantages and disadvantages which will go into the negotiation at the time you sell your business. Okay, so that is the substance of our presentation. And now we have question time. And we've gotten a couple questions in the chat boxes I see, and you can also feel free. It's a small enough group that you can unmute yourself and ask a question directly to us. Mitch and Rebecka, do you want to answer some of the chat questions that have come in?
Sure. So the only one that I see is from Kevin Chisholm. He said, I'm forming an association this year. Must it be a 501c? So no, it doesn't need to be a 501c3 organization, because the advantage of being a 501c3 organization is, or C4 organization, is that you don't have you're not subject to federal income tax. But because that's a kind of a perk or a bonus, not something that the IRS wants to give out to everybody, it's something you have to apply for. So if you don't want to fall under that category, you just don't apply, and you'll be subject to the same tax consequences as just a regular business.
Yeah, if I could add to that, I would say that 501c corporations, whether it's a C3 or 4 or 6 or whatever, are all tax exempt organizations because they serve a function other than an entrepreneur trying to engage in a business for profit. If you form a trade association or a nonprofit charity like an educational or scientific organization, you can be paid a salary, which is reasonable comp, but you can't sell the business because you don't own the business. The business is actually considered to be owned by the general public, which is represented by the Attorney General of the state that you incorporate in, and you're not allowed to compensate yourself by anything more than a reasonable salary. So that's the big decision that you would make up front on a new business. Are there others? Let's see what's in the chat box here.
I think Monique had a question in the chat, and I can just read it. I'll just go ahead. But it was, if I start multiple businesses, would I have an enterprise or file separately for each business? And maybe Monique, you could find, I might ask a follow-up question on this. Are you thinking of having, are they different businesses, or are you thinking of having different brand lines? Because those are kind of two different conversations, but I'll turn it over to Mitch, Ken, and Rebecka.
Yes, this is Monique.
Hi,
So
Monique.
yes, hi. So it would actually be different types of businesses. Like for instance, I produce events, and then I was thinking of purchasing some vending machines, and then having an educational consulting business. So like, how would I, if it was an enterprise, what following would that be?
Let me tackle that one. If you were to set these up as pass-through businesses, either as LLCs or as sole proprietorships or as S corporations, where all the tax consequences come to you personally, you would be able to offset the profits of one with the losses of the other, and only pay tax if you have a net profit. That's normally what somebody wants to do when they're setting up multiple businesses. Because these are two very different kinds of businesses, they don't sort of naturally need to be with each other. So my inclination would be to set them up as separate entities. And then the question is, do I want it to be a corporation or a pass-through? And that opens the door to the question of, are you going to have investors or partners in either of these businesses? If so, do they invest cash or capital in the business? And maybe you'll want to sell shares to them. That would be a reason to have a C corporation. Do you have a different exit strategy for one or the other? Maybe the events business is something that you would continue to operate long-term, and the other one is one that you'd like to sell. So those are the pros and cons that go into the choice of entity. But because the businesses are slightly different, I think I would suggest separate entities for them. I don't know if that's helpful, and feel free to speak up and follow up if I didn't totally answer it.
No, that makes sense. Thank you.
Okay, you're welcome. You're welcome.
And I had a question, just, in general, one of the things that we see in Biz Launch is businesses go through kind of different phases. When they start out, they might be a sole proprietor, and then, they start getting a little bit more assets, and then they become an LLC. Then they get a little bit more, or they're doing some franchising, and then they end up being an S or C Corp. What advice do you have for businesses that are making these type of entity transitions? And what are some things that when you do that a business owner needs to think about from a legal perspective?
Well, so Rebecka and I were fortunate enough to have a guest lecture in one of our classes a couple of weeks ago, and they were talking about entities that start out as an LLC and then switch to a corporation later on. And his advice was not to do that. He really encouraged people, if their goal is to get venture capitalists or other outside investors who would be passive investors, to just start out as a corporation. So he, just from the financial side, that's what he really recommended. So obviously it's maybe not the most possible when you're first starting out as a sole proprietorship or a partnership. But once you make that transition, it's his recommendation would be to go immediately to a corporation, skip LLC.
I think that makes sense. You're putting yourself in the position, once you turn profitable, to be able to sell stock and get that capital gain result. And that's usually the transition. Usually a startup business is less profitable, or it may even lose money in the first few years. You want to be able to offset your other income with that loss for tax purposes. So you want to have pass-through taxation in the early years, and then it might be more desirable to switch to the C Corp status in the later years.
No, that's very helpful. Thank you. And folks, feel free to chime in with any questions that you may have. One just general, I was just, I guess one of the main questions was about that I had about was the small business stock. I think Rebecka, you spoke about this. Is that something that, out of curiosity, is that something that came out of the tax overhaul in 2017?
Yeah, that came as a response to the qualified business deduction that pass-through entities had. They wanted to give like a reciprocal, tax benefit to C corporations.
Right. Okay. And then another thing I wanted just to add, it basically kind of, when you're thinking about your entity type, you need to kind of think about your overall strategy and also kind of that exit strategy. I think sometimes, you mentioned that, Ken, I think sometimes businesses forget, they don't ever envision themselves when they start up exiting, but that is the case, the one way or another. So what advice would you have for entrepreneurs in that idea phase and kind of thinking about entity types? Is there any tips that you might have, just kind of overarching themes?
Well, probably the best advice I could give somebody is you always want to have plan B. And plan B is what you're going to do if this doesn't work out as I hope it does, or if there's a pandemic and I can't run a restaurant profitably anymore, or if Mitch's landscaping starts making lots of money and I decide, I'm ready to go practice law. How can I sell this business and make a profit for it? So I always like to have a plan B. It doesn't mean that it's something that I would prefer to do right now, but a career is a long time. And you'll probably have a long career. And most of us don't do just one thing for our entire career. So I encourage my students to always be thinking about what's next for me. Keep it to yourself, but that will help guide you as you make these decisions on choice of entity and how they're taxed. Okay, well, I don't see other questions here. On the slide, you've got our email contact information. Feel free to reach out to any of us if questions occur to you after this presentation. Rebecka and Mitch have their George Mason emails on there. I'm actually an adjunct professor and a practicing lawyer at the Nixon Peabody law firm. So that's how you can get in touch with me. We appreciate everybody's attendance and attention. And you've been a great source of inspiration for us. So thank you for being on the call.
Thank you for joining us. And thank you to our speakers, Mitch, Rebecka, and Ken. We appreciate you joining us for this. This is a lot of great information. So thank you.
Okay. And with that, we are ending the call.
Take care, everybody. Have a good one.
Okay. Bye-bye.